And Mark, you're up.
Thank you, Len. So this is a presentation deck that has evolved over the years. I actually did a presentation with Ellie Eisenberg, who's been a longtime mentor of the Preccelerator. He's a consulting CFO for startups as well. And so some of the copy in here was gifted to me by Ellie, and I give him credit for that, but I've made it my own over the years. And I've been delivering this type of support to lots of businesses for for the last 15 or so years now. And so this is coming from the heart, guys. And feel free to just jump in with questions as I go. I don't mind being interrupted. My style is I'm going to zip through this content kind of quickly and save time to dive into actual examples where we talk about your actual startup business in context. I can pull up some Excel-based financial forecast models, and we can walk through them live and talk about how they work and why. All right. So, financial modeling for startups. I like to think of financial models as a piece of software that lets users test and validate their business model assumptions and then logically communicate those assumptions to others in a format that's universal, in a universal language that everyone understands. Okay, test, validate, and share your ideas. If you oversimplify your financial model, you miss the opportunity to validate. If your model is too complex, it won't concisely communicate your vision. So finding that right balance in the middle will cleverly demonstrate your level of sophistication to investors. Let's be honest, investors are both greedy and risk averse. So the goal of your investor pitch is to address these three things, to demonstrate credibility to the investors, to build their confidence in you, and to show them that you can make money for the business and for them in return. Okay, so your financial model needs to address those three things to help you communicate that vision and value, and to show that you can be trusted and counted on to be successful in running the business. So some rules for financial forecast models. They've got to be credible. Consider internal and external constraints. So who can, on this call right now, internal or external constraints, any volunteers for an example of what an internal and external constraint would be? Not all at once.
Well, number of staff.
Okay, people, that's an internal constraint. And if you have a business that, requires office space or warehouse space, maybe space is also a constraint that's related to people, because the more people you have, the more space you're going to need to operate the business, right? How about an external constraint? Mark, Landy, do you have any ideas?
Yeah, sure. How about credit?
Credit, all right, yeah. Ability to, for capital, let's say if you're borrowing capital. Another one could be market size. How many people are there who could potentially be your customers or companies? If you're Facebook or Instagram or Snapchat or Spotify, these consumer-facing businesses, apps, and services, if their financial model forecasts that every month their user base would grow by 10%, or every year their user base would double, and it just continues to compound period over period over period, pretty soon they're going to be forecasting that they'll have 20 billion users of their platform. But that's impossible because there aren't 20 billion people on the planet who could be users. So market size can be an external constraint. All right, so those are some examples that your financial model should consider, because it's going to provide more credibility to the forecast that you're building around those constraints. All right, address investor expectations and skepticism. Think about what questions are they going to have about your business. Is your business model sustainable? And you should have good, thoughtful answers that are supportable. Supportable with research that you do online about comp data from other businesses, market research, market sizing, things like that. You should build the forecast from the bottom up, not the top down. We'll talk a little bit more about that, what that means. But if we go back to like this picture right here, top down model would say, I want to build a house and it's going to have a window and a front door. and it's going to be able to provide all this benefit. But a bottoms-up model says, well, we need to build a foundation, and the house requires these walls and doors and stairs and windows and all these components. And if we put that all together properly, then we'll have a house. And now you're going to be much better equipped to actually build that house because your model considers all the fundamental activities, steps, and components along the way to achieve that result. Okay, correlate your assumptions to outside benchmarks. We talked about that a little bit with the internal and external constraints. Think about what are those outside benchmarks to validate, does this really feel right? Is this plausible to really occur in reality? Okay, your model must be consistent. It must be consistent with your business plan. It's hard to do if you use a generic template. If you download some templates online of a financial forecast model, there's going to be some blanks that you can fill in to make it your own, but more often than not, it's not going to follow consistently with the way your business operates because every business is unique, and that's going to create a disconnect for you to get the most value out of the model and also for your audience to understand how your model depicts and represents the business that you're trying to create.
And Mark, that really goes to the business model of the company. So if you're subscription based versus D2C product or whatever, that really changes how that model should work, that financial model.
That's correct, because if you're a consumer facing app like Spotify or Facebook, like we talked about, the way that you make money and engage with your customers, with your users, and your customers, by the way, in that business are also the advertisers that are paying money to reach the users on your platform. The activities and the dynamics are much different than if you're selling software B2B to enterprises, or if you're selling widgets, if you're selling cars or apparel through e-commerce. And so you really need to have a financial forecast model that's catered to, that tailors to your business so that it is clear the assumptions and the relationships that you're representing there. Okay, cash flow is an often yet, it's an important yet often overlooked consideration in many startup financial models. So this is an actual cash flow representation of a real business. And what's important to think about is, depending on how your business works, if you're an e-commerce company, maybe you have to pay money in advance to source product from a manufacturer overseas, and you have to pay 50% upfront when you place an order, and then 50% when they ship the order to you, and then you receive it in your warehouse or in a third party, a 3PL facility a few weeks later, or sometimes even a few months later if it arrives by ocean freight. And then only then will you be able to actually ship that product to a customer who pays for that purchase on the website. So you might have to invest that cash several weeks or months in advance before you can actually generate the revenue from that product and make the profit in between. And if you're not considering the cash flow implications of that, then you could be in for a big surprise where you don't have enough cash to operate, even though your business looks great on paper. So don't ignore cash flow implications in your business. That e-commerce example is just one example, but there's many other factors that can affect the timing of when money, cash flows in and out of a business relative to what you think about in terms of revenue and cost that you're incurring. Okay, churn rate is an often oversimplified metric in a user-based business model, yet it's one of the most important metrics in a subscription-based business. Building the right level of detail in your churn assumptions gives you much more insight and control over your performance outcomes. So this is a screenshot from an actual subscription-based business. This is an Uber for fill-in-the-blank type business. It's an on-demand marketplace business where there's users that are engaging in commerce and there's service providers that are providing the service that people are ordering and paying for. And this is a representation of what's called a cohort waterfall or retention waterfall. So what we're seeing here is coming down the left-hand side, cohort 8 cohort represents a group of people that share some common attribute. So in this case, these are people who first signed up for the platform in August of 2016. And then this next cohort down the list are people who signed up in September of 2016, 59 of them. And then 44 people signed up in October of 2016, and so on. And of those people, these percentages off to the right show how did those people behave 1 month after August of 2016, and 2 months after, and 3 months, and so on. And it's all relative, because these people who signed up in January of 2017, 1 month later, it's February of 2017. But February of 2017 for this cohort is way out here. So it's important to look at these metrics and understand what they mean about your business. And think about, again, with, let's just use Spotify, or let's use Instagram as an example. So Instagram is a user-based business it's a messaging platform. So if I discover Instagram and become a user, and I'm part of this cohort right here, then I'm going to start sending messages to my friends, or Snapchat as an even better example. And then my friends are going to learn about the platform because of me. There's a big organic referral activity that's happening, and they're going to sign up and start using the platform and sending messages to their friends. But after a few iterations of that, all of the friends in our overlapping circles are already going to know about the platform. They're already going to either be users or decide that it's not for them. And that organic referral activity, can someone turn their sound off? Whoever's getting calls there, thank you. That organic user referral activity is going to have diminishing returns over time for that same respective user base, because once all of our friends know about the platform and have tried it, there's no more people in that group to refer. Also, with regard to churn, every piece of software or product isn't right for everybody. So, certain percentage of users, in this case right here, this is saying that 79.1% of these 43 people continued to use the platform 1 month after they started in August. And then it's hard to see on this chart, but this is 58%, 58%. That means that these people started dropping off. They decided that the platform wasn't for them 2, 3, and 4 months later. And that's no surprise. If this was the very first month that the platform launched its public beta, that if I'm the entrepreneur, I'm going to be telling all my friends and family, hey guys, I'm really excited. We just launched our new app. I need everyone to sign up for it. Please try it, tell a friend. And of course, all my friends and family are going to sign up because they want to support me, but they may not be the right user base for my platform. So they're going to have a high churn rate later, a low user engagement rate. And then it takes a few months to really hone in on who are the right users for the platform. And you can see the engagement rate here, 3 months in for this third cohort, are much higher. So these users are more sticky, they engage more, and they're more valuable for the business. Another example would be if you did a big promotional push where you said, all right, everyone who signs up now gets 3 months free, or gets premium features at a big discount. That oftentimes works if you're sending the message to the right audience, but you can end up losing a lot of money and wasting a lot of time by giving away those promotions to the wrong users who weren't ever going to be the right users to pay for your product at the normal prices ongoing. And in any event, you'll see a big spike in user acquisition, but then when that 3-month promotional period is over, you'll see a big drop off in the churn rates. And so the bottom line is these churn rates change over time from month to month, and the aggregate churn rate percentage across all users in total is going to be different from 1 month to the next. And if you just have a financial forecast model that just says we're going to see 3% churn across our user base every month, month over month, forever, that doesn't really take into consideration what actually happens in the real world, and you're going to have a big margin of error. So I encourage you to study, if you have a user-based business, whether it's a B2B play or a direct-to-consumer subscription model, study the data you can find online about other similar businesses and really try to understand the how and why for the user churn and build that into your forecast model. So if this was the data that we had empirically about how this business had been performing to date, we would use this information to extrapolate into the future and predict the user behaviors relative to when each new user starts the program in the future. That's a lot, but hopefully that shows you how important it is to really think about user retention, churn, and the organic virality in the right context. You can't oversimplify that part of your business model. Okay, so know your business model well, inside and out. Who are your customers? How will you reach them? How much will they pay you? What activities and resources will you rely on to succeed? What are the relationship dependencies between those different stakeholders? And how do those assumptions change over time? You have to think about all those things to really know your business model well, and that's part of addressing investor skepticism from before. If you're the expert on how all those things work, it builds investor confidence. But investors can poke holes in your business model assumptions and you don't have good answers for these type of questions, then investors don't believe that you're ready to take their money and build this actual business now. So aside from the financial model itself, the process of creating a bottoms-up financial model and testing different assumptions is often the most valuable result of the whole exercise. The amount of effort that you spend going through that process and then the resulting ability you have to explain the business model in detail to others indicates your capacity to successfully manage the business and builds a lot of confidence in investors that investors have in you. And it sets you up to succeed because it lets you see around corners and anticipate potholes and challenges that you're going to encounter along the way because you've modeled it out in detail. You've built this, you have this drawing that talks about where everything is going to go and how and when. And so you're not going to be surprised to find out that you didn't have a long enough beam to go across this top piece right here because you've already thought through all that stuff. Okay. Should we pause for questions? Anyone speak up if I'm going too fast or slow?
Let's see, prepare a good answer for the one question. Oh. So Frumi said, just prepare a good answer for the one question you hope an investor won't ask.
Good point. Yeah. And so walking through your forecast model and your pitch deck with advisors like you get through the Stubbs, Allerton, and Markley's Preccelerator program, and with other advisors and fellow entrepreneurs, it lets you kind of test your story and get lots of questions and insights from lots of people, and you should memorize that stuff so you're ready to have answers to all those questions if you get them again in the future. Don't just try to wing it because investors will see right through that and they'll come to the conclusion that you're not ready to make good use of their money.
Mark, one of the questions that comes up a lot, and this goes back to churn and calculating lifetime value of a customer. Will you address that at all during this, or is that for another time?
Sure, I'll talk about that, and we can do we can pull up a real example in an Excel spreadsheet. But for now, if I'm just looking at this right here, to calculate lifetime value, we say, all right, these 43 people, how many of those people are paying for the product today? And how many of them are paying 2 months later and 3 months later and so on in like a subscription-based business? And then you kind of do the algebra, 43 times whatever they're paying per month for this many months. And down over here, there might only be 12 people left of those 43 that are still paying. So it's 12 people times whatever they're paying per month all the way out. And then you divide that by 43 to give you your lifetime value of those subscribers. Because on average, each subscriber will pay that sum of money in total for your product. If it's an e-commerce business, then customers, you have the concept of average order value. What's the average amount that customers pay for when they order product on your website? and that amount might change over time, but you have an average order value, and then you also have an assumption for once someone buys something from you once, how often and how many times do they come back and buy more from you into the future? And if you add all that together, that's your lifetime value of an e-commerce customer. So if you're spending, let's say, $50 to acquire a customer by posting ads on Facebook and Instagram and through other channels, affiliates, and on average, it costs you $50 to get a customer to come to your website and buy something. And that customer buys a $100 purchase, and your profit margin after shipping and all your other fees is, let's say, 40%. So you get to keep $40 out of that $100 that your customer paid. Right there, you've lost $10 net from that customer because you paid $50 to acquire them. You earned $40 of profit, so you're $10 in the hole. If that same customer is expected to come back in 3 months and spend another $100 and come back 3 months later and spend another $100, now your lifetime value on that customer is 40 times 3. It's $120. So you've made $120 profit compared to a $50 acquisition cost. I'd do that all day.
Hey, Mark.
Yeah.
So that makes sense. I was going to give you a sense that you were going to stop right away. What do you think, though, using your example of consumer-based products, what could be considered statistically significant data set? So, for example, here you said, okay, I have 40 customers. Mm-hmm. Can I extrapolate from that? Okay, that's going to work at 400, 4,000, 400,000. So, since you kind of look at these things for startups, what does my customer base need to be on a consumer where I can say, okay, I got enough to have my data set to make it reliable?
Yeah, really good question. There's no one right answer. It depends on, your business. So let's say I talked to an entrepreneur the other day. It was a software product that helped people go through the divorce process. No fun process. It takes, divorces can take multiple years in legal proceedings, but with this software-driven process, if it's the right fit, whatever, it's supposed to take 3 months from start to finish. So basically, a customer has a lifetime value for whatever they're going to pay for that product over a 3-month period, and then that's it, and then they're gone, right? So that customer is not going to continue to generate revenue for that business for a year or 3 or 5 years into the future. And if you're an e-commerce company and the only thing you're selling are masks for protecting people from COVID, like face masks, and that's all you sell, your lifetime value of that customer is probably not very high and doesn't have a long tail, again, because you're not offering something of value ongoing into the future. So, you might be able to make good use out of a small sample set, because if you acquired 10 or 50 customers that fit a certain profile, age group, demographic, income brackets, whatever, and you could see how those customers are responding and what they're paying, that might be enough data to give you the confidence to invest more money in marketing and continue following that pattern. But if you're running a user-based business that requires thousands or hundreds of thousands or millions of users to generating a meaningful amount of income from advertising revenue, then you need potentially millions of data points before you have advertisers who are willing to commit a meaningful amount of spend on your platform that gives you the revenue that you're seeking. So the answer, it really depends. What you can do to supplement when you're early on and you don't have your own data is look for market comps. Try to find this type of information about other businesses that's publicly available, either because they're public companies or because their prior pitch decks are publicly available on SlideShare and on other platforms, and you can go look at what they were talking about when they were earlier on in their business trajectory and extrapolate from there and base your assumptions around their results. Good question, Mark. Okay, so when you're building the model, you got to organize your information logically, clearly display your assumptions so that people don't have to guess where are these numbers coming from. it should be pretty intuitive to someone who is familiar with looking at financial models, how yours are structured. So follow convention. Forecast things by month. So often I see early stage entrepreneurs use like a private equity forecasting model, which has maybe 4 quarters and then 2 years of annual results after the 4 quarters, or maybe it has 12 months and then year 2 and year 3. That's fine for summarizing the results of your work, but your detail needs to start at a monthly basis. A lot can change from month to month. And if it takes you a month or 2 longer to raise the capital you need to hire the people and to start operating the business the way you're intending to, and your forecast model is built by quarter or by year, it's going to be really painful and probably prone to error for you to try to shift your assumptions to represent how that's going to change now a few months into the future. And the inverse is true as well. If you accomplish goals faster than you anticipate, then it's going to be really difficult for you to accelerate your growth model and adjust those changes if you're not doing things by month. Lastly, like if you have a user-based business and people are paying on a monthly basis for what you're selling, even if they're prepaying for a year up front, you can't just say, well, we have 0 users today and we're going to have 1,000 users at the end of 1 year. You can't just multiply 1,000 by like the annual average price, because some of those users are going to start in January, some are going to start in February, some are going to start in November and in December, and they're going to pay different amounts relative to their start date within that 1 year. So you have to do the calculations by month, and then you can have a summary page that summarizes by quarter or by year the aggregation of all those monthly columns. Okay, 3 to 5 years or until your exit. An early stage company like the companies that work with the Preccelerator program, most likely 3 years is plenty. Investors probably aren't going to want to invest enough money to last you more than 18 months, but they want to know what your vision is for what's going to happen next after you achieve those milestones that you're targeting over the next 18 months and you're out raising capital to continue growing the business. What's your vision? What direction are you headed? Are you implementing new products? Are you going after new markets? Are you going to hire more staff? Like what's going to change in the future, and how much more money is it going to take to be successful? Don't ignore cash flow implications like we talked about. That's hard if you don't have a finance experience, so work with an advisor or a consultant to really think through that and don't catch yourself by surprise later. Summarize your KPIs with context. I'll show you an example of that in a minute. And then it should go without saying, but review and test your work. You don't want to have mistakes in your financial forecast model when you're sharing it with others. How can you expect investors to have confidence in your ability to create and run a business if you have errors in your financial model before you even get started, when you're trying to present them what you're setting out to accomplish? Okay, so if you're presenting financials in a pitch deck, you really just need to summarize these kind of things at a high level. Revenues, profit, or cash flow. Don't obscure the facts. Don't show cumulative revenue. If you're forecasting $1 million revenue this year and then $2 million next year, don't show a graph that shows 1 million this year and then 3 million cumulatively next year and then 10 million cumulatively by year 3, because investors don't want to feel like you're trying to pull a fast one on them. They want you to be very transparent, direct, clear, and you know, if you're trying to manipulate data to make yourself look better, they're going to see right through that and lose confidence in you. Don't lose your audience in the details. This does not belong on a pitch deck. Nobody wants to be squinting at a screen trying to read these numbers, and you certainly don't want your audience to be focused on a bunch of numbers like this as opposed to listening to what you're sharing. So a chart can add a lot of clarity. Here we see some context. So this shows that the business is planning to raise a $750K seed round. in the first year, and then has intentions to raise a $2 million Series A in year 2. And that shows how the business is going to sustain while the purple net income numbers are negative, while it's burning cash each year. This is additional context that shows what the business intends to accomplish over that time period. Release the public beta by year 1. Get 10,000 or more monthly active users by year 2, and so on. So that context adds clarity that tells the whole story around those numbers. In an executive summary, which is usually like a 1 or 2 page written document as a Word doc or a Google doc or a PDF, you might include a table like this that shows, again, the context up on the top, the KPIs that explain how you achieve the financial results down below, because then it tells the whole story in one picture. In your pitch deck, you're going to need to ask for the amount you're investing if you're trying to solicit investment from professional investors. You need to cover these things: the amount and use of funds. How are you going to spend that money, in what categories, over what time frame, and how much money are you keeping on reserve as a contingency for things that are unexpected? Okay, sources and uses of funds is really kind of what that is. Target milestones. Are you going to release your product in a certain period of time? How many customers do you plan to attract by then? What are the revenue and profit results you're forecasting? What valuation are you offering? It needs to be reasonable and justified. Basically, what percentage of your company are you offering to investors in exchange for their capital? And what future capital needs do you anticipate? Investors know that they're going to be diluted, so they need to understand how much more money it's going to realistically take for your company to achieve success, so they can calculate what their dilution expectations are, and ultimately like what the return is on their investment that they should expect. Okay, so here's an example solicitation that covers all those things. You might not want to jam all this stuff on one slide. You could break it up into a couple slides, but you need to cover all of these 4 areas. If you don't cover those, you're going to waste precious time in your Q&A for investors to ask you to verbally answer these questions, and it shows that you're just not ready to make good use of their money. So answer all those questions in advance and save the Q&A to get the investors even more interested in your business. All right, so to recap, you need to appeal to investors' greed to mitigate their risk. I don't want to read this stuff to you. It's here. I can send a copy of this deck out to everybody who signed up for the webinar. And that's what we want to accomplish with the financial forecast model. This is me and what my business does. And we'll open it up for some more Q&A. We can bring some financial forecast models up on the screen and walk through them. Whatever you guys want to do. Are there any more?
Yeah, there's a question Lou Carpenter asked. If you're looking at a user-based business, do you need to create separate charts for retention and churn for subscriptions versus an a la carte in-app purchases?
Well, retention and churn are inverses of each other. So you really need one or the other, but you can have one drive the other. And yeah, you need to calculate what are those users going to do that's of value to your business and that's going to cost your business money. Do you need to employ customer service personnel to interact with those customers? And as the user base grows and you have more users, you need to staff up your customer service team to interact with them and to provide them the appropriate level of customer service, or sales, or whatever else you're doing to interact with your customers. Also, you'll be calculating how those customers are going to interact with you in terms of payments. Are they going to opt for kind of the entry level or the premium or the enterprise level subscription that they pay a higher price for? And that enables you to calculate your revenue. All right, maybe, are there any entrepreneurs here on the call that has an actual business that I can pull up an example model about? And Marshall, I saw your question just come in here. How much would you spend on including external factors in your financial model? Example, change in tax code, increase in cost of goods sold, new competition into the market. Well, it takes, depending on how complex the business is, it would cost a professional like me somewhere between $4,000 and $8,000 to build a financial forecast model that really considers all those factors. As an entrepreneur, if you have enough skills in spreadsheets, you could do it yourself without having to pay somebody else, but you should definitely still seek the advice and feedback from advisors and mentors to poke holes in your model and help you make it as robust as it can be. In terms of external factors, it depends on how much leverage, how much influence those external factors can have on your business. Competition is really important. That's a very relevant external factor you should do your homework on. Understand who your competition is, who they could potentially be in the future, and how and why that matters to your business. Change in tax code generally isn't very relevant for most startups, but for some that are in fintech or in certain other niche industries, it could be very relevant. So if you have an example of that, we can talk more about it.
Mark, let's talk about valuation for a second, because I think it's, at the very early stages, my advice is always don't worry about valuation, because you really can't put a value on a company that has no revenues and has no users and is just an idea. But when they go in front of an angel group, the angel group wants to know what the valuation is. So how do you mitigate that in a financial model?
I'm glad you asked. Thank you, Len. I'm going to bring up, let's see here, slideshow. Okay, valuation. Sorry, I'm just pulling up another presentation I did that was on valuation and founder dilution. So this is really relevant. Okay. So there's a few different methods for valuing early stage companies. Let's say that really the value an investor is going to attribute to your company is based off their expectation of the future value that your company can deliver, right? So here, there's this one method way back in the mid 1990s. There was an angel investor named David Burkus who developed this method called the Burkus method. Burkus method assesses a startup's value based on the 5 criteria that you see listed here. It's quick and easy, but it's very subjective. It misses potentially important factors like market size. And since it's almost 20 years old now, you should probably double these amounts. But with an early stage company that doesn't have revenue yet, you could just kind of rank how you can score how good the company is on each of these 5 areas and attribute an amount between, let's say, 0 and 500,000 for each of those scores and like a 1 to 5 rating scale, and come up with a valuation that way. Publicly traded companies are valued based off of the dividends that those businesses pay to shareholders. They're basically taking the company profits and giving that to shareholders, and that in large part determines the value of the stock, because the people who own the stock are getting to share those profits. But with an early stage investor, they're investing in a business that they're probably not going to get a return on their investment for 5 or 10 years, if at all. So let's go look.
Mark, if you went to Tech Coast Angels and you said, okay, we've come up with a valuation of $3 million for our company. And the question back is, well, defend that. How did you come up with it? Well, I used the Burkus method. And these are the values I assigned to each one of these. Are they going to look at me like I'm crazy, or they're going to say, oh, that's brilliant, David has done a great job?
Well, I mean, if you have a thoughtful approach, the Burkus method could make sense. Really, what it comes down to is here. Let's look at this. This is what investors are thinking about. If an investor gives you $1 million at a $4 million pre-money valuation, like what's right here, this seed investment, then they own 20% of your company that's worth $5 million. So they basically have $1 million of value on paper. After you raise money a few times and the company, makes progress in the market and generates more enterprise value, let's say you go through a Series A investment, you raise an additional $10 million here, and the company is worth $50 million on paper at that point in time. The original investors had 20% of a $5 million company. Now they have 13% of a $50 million company. And if you fast forward all the way through to exit, let's say this company has an IPO at $1 billion, however many years out into the future, those same investors own, and according to this scenario here, own 5%, that little skinny red line down on the last column on the right, 5% of $1 billion. And so investors they see into the future and they say, all right, how much more capital is it going to take to get your company to success to the point where it can be worth that money and we have a liquidity event where everyone gets paid? And how much risk am I taking on by giving you my money today in hopes that you're going to achieve that exit in the future? And what's that risk worth to me? And that's basically the equation they come up with. So they're going to back into it that way. Whether you say you use the Berkus method or some other method, it really comes down to how much return does the investor expect to get for taking the risk of giving you the money today.
Mark, when I led the Harvard Business School Angels, I think when we looked at valuation, you're right, we're looking at risk and return, but I think we're also looking at we're looking at the other investment opportunities. So we're comparing it to market as well. So we have our limited resource, our capital as angel investors. And it's like, so do we invest in company A and they might have a experienced management team and whatever, and everyone has great pitches, right? Or do we invest in company B that has a less experienced management team? And then we're looking at the different valuations that they're looking for. And again, we're looking at, like you said, our risk reward profile. So, but I think it's some of it's more of a market dynamic than individual company.
You're right. I mean, it's kind of like the real estate market where you look at comps out there. And so here's another example of kind of typical valuations you'd see in the market for businesses that are raising their angel to seed round. They would be, you'd expect the technology to be developed. Nowadays, like Tech Coast Angels most often wants to see that businesses have a little bit of customer traction. They have some customers that are actually paying for the service. So there's validation that people are willing to pay for whatever you're selling. And those valuations are going to be in like the, 3 to 4 million range on up to like $20 million right now. If it's over $20 million in value, it's an exception at that angel investment round. But you look for market comps, like basically what were professional investors willing to pay for other businesses that are similar, and does that justify the same relative price for that business, for your business today? There's another method here. This is this one is called the VC method. This was made. What's that?
I'm listening to the last part of this.
Okay. This method here is called the VC method. It was actually made popular by Professor Bill Solomon from the Harvard Business School. Are you familiar with this? Or, sorry, not that one. This one right here. Are you familiar with this method, Mark?
I've seen it before. Yeah, no,
okay.
I like it.
Right. So this basically says, here's how much we think the company is going to exit for. We want to get 20-time ROI on our investment. So that means that the investor today would invest in a business with a post-money valuation of $5 million. But then you subtract the $1 million that you're asking the investors to put in, that gives you a $4 million pre-money valuation. And with a $4 million pre-money valuation, we anticipate that there's going to be additional capital raised into the, like, to get from here to that $100 million exit. So let's assume 30% dilution. You take 70% of that 4 million and say, I'm willing to value your company today at 2.8 million because I think it's going to take that much to get to this $100 million exit, and I want to get a 20 times ROI on my investment today. So if I give you $1 million today, I'm going to value the company at $2.8 million before the investment. Is that, hopefully that answers the question for some folks.
And that's with a total of $5 million raised.
No, that's with a total of $1 million raised. So if you, with this example, let me pull that up again. With this example, the company is getting $1 million of new capital from investors on a $2.8 million pre-money valuation.
I get it, sure.
$3.8 million post. And so you're giving up like more than 25% of your company to those investors for that money, which is a lot to give up. Usually, in, you know, as you can see from, let's pull up this graph here, it's common to give up about 20% of the equity in the business at each capital raise, each raise. The new money gets 20% of the business, and everyone gets diluted by 20% who was already on the cap table before. So these investors here who own 20% after the seed round, they lose 20% of that 20%. So they go down to 16%. And the founders who had 80% of the company lose 20% of that. So they go down to 64% ownership in order to give that 20% to the new investors. That's how the dilution works.
Yeah. Hey, Mark, and I'll say, you know, I'll chime in as a, you know, also running the, you know, VC Alliance. As investors, we don't want to take a 30% position. Generally, we want around 20, between 20 and 30, as we want room for further investors to come in down the road.
Right.
And,
Well,
and we want to have the entrepreneur to have skin in the game. So
thank you for saying that.
We're looking at that 20% is pretty much the magic number. It's like, okay, you know, so I think one way entrepreneurs can look at valuations, you can do it backwards. Okay, how much money do I need? And okay, I'm gonna sell that for 20% of my company.
That's right. So exactly. So you basically say, I need $1 million. So 20% of 5 million, like $1 million is 20% of 5 million. So that's my post-money valuation. Subtract the 1 million, that gives me my $4 million pre-money valuation. That's basically how you assume 20% is
exactly what I said.
Yeah, exactly. And this dilution chart right here shows you the skin in the game. Like at this point at Series C, the founders and the like common stockholders, like people who got issued stock options, let's say, and stock grants, they have 31% of the business. And if the business is worth $600 million after that round of funding, is 31% of $600 million, is that enough skin in the game to keep people committed? Or would they just, you know, if those founders got diluted to just 1% right there, well, that might not be enough to keep them focused and committed to see the business all the way through to success, to like a successful IPO. So here's an example here. Like the founders in this blue area they start with 80% of the company after the seed round. And at the IPO, they have a much smaller percentage, but it's of a bigger pie. So they have a bigger slice of a smaller slice of a larger pie. And that's the equation that keeps everybody with an equitable stake in the business.
Yeah, it's like, do you want 80% of $1 million business, or do you want 30% of a $600 million business?
That's right.
Yeah.
Okay, good questions on valuation.
There's a couple of questions in the chat here. Let me just, I don't know if you can see them, but let me, one is from Armagon. Does this method account for variation by round? He was asking Mark that. And then Solomon asked, is 70% typical dilution assumption, or is this bespoke to the business?
So 70% was just like it was just a simple academic example of this right here. You know, if we take this 20% right here and go down to 5% eventually, that's basically like a 75% dilution. So these investors would expect to get diluted by 75% down to 5% of their original equity stake, a quarter of their original equity stake all the way here at IPO. So that would be a different calculus for that investment. But that, like the Harvard Business School, where is it? There we go. This one just simplifies that and aggregates the dilution down to 30% in total. So it really depends on how big your business has the potential to be, how many rounds of funding it would realistically take to achieve that exit, and how big the exit could potentially be. Okay, $100 million exit is a lot easier to achieve in most cases than $1 billion exit, which is why this is only anticipating 30% dilution as opposed to 75% dilution in that other example. What else do we have on here in the chat?
What are the dangers of undervaluing or overvaluing your pre-money valuation? That. Well, you won't get funded if you overvalue.
That's right. If you overvalue it, investors aren't going to want to put money into the business. Trying to find an example here. Well, we're getting too deep into dilution now. But if you undervalue the business, then you give up too big of a piece, and you might not have enough equity left to attract more capital and raise more money in the future. And then you have that challenge where the founders have too small of a slice, and there's not enough skin in the game to attract new investment, because the investors aren't going to want to put $50 million into the business to allow you to keep growing if the founders are at risk of just walking away tomorrow because they're like, I can make more money if I just get a job at Google. So that's the risk of undervaluing your company.
Excellent. Are there any other questions in chat? Now, there's a private conversation, I think, going on between Mark and Lou, so we'll leave that for them.
Well, I'm glad they brought up WeWork though, because I have a financial model I built for a co-working business, so I can bring that up as a teaching tool if you guys want to look at it.
Sure.
Okay. Let's look right here. Okay, so this is like kind of an annual summary of this business. So this shows what is projected to happen in years 0 through 4, 5-year time horizon. And here's the KPIs, tells us how many locations the business intends to launch, over this time horizon, how many paying members are going to be generating revenue for the business, what the cost per acquisition is per member, and AARPU stands for average annual revenue per user. So on average, the business is expecting that people are going to be paying this much per person. Staffing headcount, and then here we talk about the financial performance. So this is revenue and costs, and then we get to EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's basically like an apples to apples way to compare the profitability from one business to the next. So that's how much profit the company is making. And here's a chart that shows that forecast, but all this is a summary of the detail. So what do we care about? Right here, this part of the model talks about what does it take to open up one physical location, one WeWork location. We have to spend some money on access control systems and putting in a Wi-Fi system and doing other stuff like that. And then eventually, 10 months after we start construction, we'll be able to open the doors and start bringing people in to pay for shared desk space, dedicated desks, and other features of the co-working space. So if we have this many people that are paying for memberships in the first month, and then in the second month, we grow that membership base by 15% and so on into the future. And if each of those people on average are paying these prices right here, then this is the revenue that we'd forecast. And then there's other things happening here. We subtotal the different types of revenue. Then we'd have these staffing costs. We'd have to hire all these people to work that particular facility, and we'd have some other overhead expenses as well to run that facility. All right, so that's what we know happens in one location. Then the way this model works is it says, well, let's assume that the first location starts at this date and the second location on this date and so on down the line. And we can have this kind of cascading waterfall of memberships that's all relative. So this says, here's what's going to happen when we start the first location. We'll have all these memberships, and there's lots of detail underneath here. And then the second location kicks in, so we have more members here, and then the third location, and so on. And so this model kind of adds that stuff up. Here's the revenue that's going to be generated from those users. Here's the operating expenses that those locations are going to incur. And again, there's more detail under here for each of these individual locations. And we can kind of start totaling all this stuff up and say, here's the total amount of income that this business can generate if it has all of those locations operating in synchrony with each other. And then it would have to employ some people to work in the kind of corporate office, the CEO and some other operators that aren't physically working at one location, but they're working in the corporate office. And then some other overhead expenses to run the business. And ultimately we get to a certain amount of income. Okay, so then on a monthly basis, we can total that all up for the business. We can total up revenue and direct costs, overhead, and get to our net income. We need to take into consideration cash flow assumptions. So there's a cash flow model here that talks about the different timing of when the money comes in and out, because when we're starting with a brand new building, we have to spend this money here to build the facility out well before we start making profits. And we have to hire these people and pay them a salary before we have enough work for them all to do. And so that's part of the cash flow timing. And ultimately, it gets totaled year by year. So that's one example of a co-working business model.
Cool. Thanks for sharing that, Mark.
Sure.
Really interesting stuff. Does anybody else have any questions? We're coming up on an hour here. And
Mark, I'd really like to get that slide if you could, because I have a nonprofit and I'd like to see what I can convert those numbers into for my nonprofit membership.
Okay, sure. The co-working business model.
Uh-huh.
Yeah. Sure, Karen. Why don't you just email me and I'll be happy to send that
Thank you.
model out to you. Sure. Now remember, it's not a one size fits all, and if you try to kind of shoehorn your numbers in there, you might end up causing some problems for yourself. So consider these models, if I share a copy with you, as a teaching tool.
That's all we need.
But you're on your own if the formulas don't tie out.
No, I'm not expecting perfection. I just need a tool.
Okay.
Thank you
Sure.
so much.
Sure. I'll mention because this is a Preccelerator program, one of the startups in the Preccelerator is a company called Ballpark. And Ballpark is a financial modeling software that's it's cloud-based.
Wow.
So let me pull it up here. It's Ballpark, BALLPARQ.io. So it's a play on words for like a baseball ballpark. And the idea is this model helps you get within the ballpark of your financial needs and financial projections. So it's not a spreadsheet. It's basically kind of like a form-based tool where it asks you some questions to input your assumptions, and then you get outputs like this that are charts and graphs and KPI summaries. And Ballpark is a Preccelerator company, or it's like a product of one of the Preccelerator companies, and I co-founded this company. I provided kind of the financial know-how behind the scenes for how all the formulas work to generate this value. So it's free to sign up. I encourage you to give it a try.
Oh,
It's
wow.
at a minimum a great learning experience to ask yourself the right questions to develop the financial model that fits your business.
Thank you.
Okay.
Super, Mark. Thank you very much for sharing that.